Good morning. July ended with the most valuable company on earth telling its investors that it cannot buy enough parts. Apple fell about 7% on Friday, not on weak demand, on a warning that component supply is constrained. On the very same tape, Amazon rose more than 15% on a cloud quarter that grew almost 37%, and management raised this year's capital spending plan toward $220 billion. Read those two together, and the week stops being a story about an artificial intelligence crash. The build is now bidding parts away from the best supply chain ever assembled. That is not a bubble deflating. That is a bubble with pricing power. And then, after the closing bell on the last day of the month, Washington bought yen. This is the Asymmetric Daily Brief for Saturday, August 1st. Here is the board. The S&P 500 closed Friday at 7,489. Up 0.7% on the day, but down 0.1% for July. The Nasdaq gained 1% on Friday and still lost 3.2% on the month. The Dow added 277 points to 52,485 and booked a fourth straight winning month. The 30-year Treasury closed at 5.249%, the highest since 2007. The 10-year sat between 4.71 and 4.74. Brent crude settled at $90.12. Up more than 20% across July, even after falling 5% on the week. West Texas closed at $84.67. Gold sat near $4,076 an ounce, softer as long-dated real yields rose. Bitcoin traded around 63,700, having opened above 64.7 and faded all morning. Volatility closed near 17.5, priced for a quiet weekend that may not be one. And here is the concentration in one line. Friday's index gain was Amazon up 15%, Alphabet up 7%, and Nvidia up 3.5%, carrying an index in which Apple fell about 7%. That is not risk-on. That is a reallocation inside the same trade. First read, everyone read Apple's drop as an iPhone problem. It was a bidding war that Apple lost. Apple's guidance problem is components, not customers. It closed the quarter with iPhone revenue up and China recovering. What it could not promise was inventory. And the binding item is memory. This is today's deep dive, so I will keep it short here and let the full breakdown carry it. The price action in memory is not subtle. Conventional memory contract prices rose roughly 90 to 95% quarter over quarter in the first quarter of this year, and another 58 to 63% in the second. Flash storage contracts rose 70 to 75% in the second quarter alone. Gartner models memory up about 130% year-on-year for 2026. And Micron expects the shortage to run through 2027. The mechanism is an allocation decision, not a shortage of factories. Memory makers are steering capacity toward artificial intelligence servers and high-bandwidth memory because data centers pay more per bit than phone makers do. Apple locked flash supply ahead of the spike and still ended up warning. It has already raised iPad and MacBook prices, and said plainly that the cause is memory and storage costs driven by the data center build-out. Second read, everyone is watching the Federal Reserve. The price that actually moved is the one the Federal Reserve does not set. The committee held at 3.5 to 3.75% on a 9-3 vote, with 3 members dissenting in favor of a hike. The 30-year then closed the week at 5.249%, its highest since 2007, and the 10-year rose to roughly 4.7. That is a term premium move, not a policy path move. A committee with hawkish dissent and no forward guidance widens the distribution of outcomes at every maturity, and the long end charges for distribution. Stop modeling a cut path, model a range. Third read, everyone says the consumer is cracking. The data says the consumer is the reason rates will not fall. The University of Michigan's final July sentiment index came in at 55.2, up from 49.5 in June. That is a second consecutive monthly rise and a 5-month high, with one-year inflation expectations easing to 4.2%, the lowest since March. A widely shared video framed the July print as the worst consumer sentiment ever recorded. It was not. It was the best since February, and the record low was set back in May. This matters because it resolves an apparent contradiction. A resilient consumer and a 5.25% long bond are not opposing signals. The first one causes the second. Follow the money and start with the story almost nobody led with. On Friday, the New York Federal Reserve sold euros to buy yen on the Treasury's behalf, executed through Goldman Sachs and Morgan Stanley. It is the first American intervention to support the yen since 2011, and it came a day after Japan's own operation, with the yen near 40-year lows. Dollar-yen firmed to roughly 157.6. The United States does not intervene in currency markets casually, doing it to stop the yen falling. In the same week, the American 30-year hit a 19-year high, reads as one problem seen from two ends. The global cost of long-dated money is repricing, and the funding structures built for a cheaper world are being unwound in whatever order the margin clerk reaches them. Interventions not accompanied by a change in rate differentials historically fade. Watch whether 157.6 holds. Gold, meanwhile, sat near $4,076 an ounce and eased on the day, for a straightforward reason. Long-dated real yields rose, and gold pays no coupon. Here is where the month's two narratives collide. Prices for artificial intelligence infrastructure fell hard in July. Spending did not. Amazon raised its capital spending guide toward $220 billion while reporting cloud growth of almost 37%, an operating margin near 39%, up about 650 basis points year-on-year, an annualized run rate around $169 billion, and a backlog of roughly $496 billion. Demand accelerated into a drawdown. The correction was in the financing of the trade, not in its cash flows. And Apple's component warning is the physical evidence that the build-out is still crowding everyone else out. Energy. Iran's Revolutionary Guard struck tankers transiting the Strait of Hormuz under American naval escort on Friday, and 4 more turned back. Reports indicate a fresh United States strike on Iran was ordered for as soon as this weekend, with energy infrastructure among the likely targets. West Texas closed at 84.67 and Brent at 90.12, both up about 1%, capping a July gain of more than 20%. The strongest month since March, even as prices fell 5% on the week. And here is the number that makes this asymmetric. The Strategic Petroleum Reserve held about 308 million barrels as of the 24th of July. That is the lowest level since 1983, after roughly 104 million barrels of withdrawals since late February. The United States is walking into a possible supply shock with its smallest buffer in 4 decades. And oil closed the week down. That is not a market pricing the risk. That is a market pricing the last 3 de-escalations. Crypto, Bitcoin traded around 63,700, opening above 64.7 and fading. The market structure bill that represents crypto's main catalyst this year passed the House 294 to 134 and cleared Senate banking 15-9. It still has no floor vote scheduled. Negotiators have treated the 7th of August as the practical deadline for 2026 path, and the majority leader has said it likely lacks the runway. The blocker is an ethics provision restricting federal officials' digital asset activities. Prediction market Polymarket prices passage this year near 33%, and Galaxy Research is at about 30%. Positioning for a legislative catalyst here means positioning against the congressional calendar. Sectors in play: semiconductors and memory. The Philadelphia Semiconductor Index fell 28.6% from its June 22 peak during July, and the infrastructure names at the center of the leveraged unwind, including SK Hynix, CoreWeave, Nebius, Micron, and Bloom Energy, dropped between 35 and 47% on the month. The bull case is that memory contract pricing is up triple digits and effectively sold out. The bear case is that every one of those names is now a former hedge fund crowding target with an uncertain marginal buyer. The read: the pricing power is real, but the shareholder register is not the one it was in June. Megacap platforms. Cloud at almost 37% growth with a 39% operating margin is the cleanest monetization proof this cycle has produced. While Apple's warning shows the same cycle is a cost line for anyone who buys memory rather than sells it. Within one index, artificial intelligence is now both a revenue line and a tax, and Friday priced the difference at 22 percentage points in a single session. Energy. A record quarter at Chevron, oil up more than 20% on the month, and the thinnest strategic buffer since 1983 into a live conflict against a market that has now faded 3 separate escalations and been right each time. Positioning is short the tail. That is what makes it a tail. And on sentiment, from market and social sentiment monitoring, commentary this week clustered almost entirely on whether the artificial intelligence trade is breaking, while the currency intervention and the long end drew almost no attention at all. The tell, everything else on this page, is a market moving. This is a government acting. Washington's first yen support operation since 2011 tells you that stress in the carry and duration complex reached a level where a United States authority judged it a problem for American financial stability. In the same week, the 30-year printed a 19-year high, and a fund running 4 times leverage was liquidated into a single block trade. 3 events. 3 asset classes, 1 underlying variable. The world is repricing the cost of long-dated money, and everything financed against the old price is being marked to the new one. On the radar, a possible United States strike on Iranian energy infrastructure this weekend, which would gap oil on the Sunday open against that 1983 buffer. The 30-year at the Monday open, where 5.25% is the level that decides whether July's month-end equity rally survives contact. Dollar-yen back toward 159, which would signal the intervention failed and should be read as carry and government bond stress, not a currency story. Floor action on the market structure bill by the 7th of August. Credit spreads, where a second levered casualty from the July unwind would show up first, and third-quarter memory contract pricing, which is the direct test of today's deep dive. 3 new calls go on the scorecard. 1. The July drawdown did not change artificial intelligence capital spending. Falsified if any American hyperscaler reduces its 2026 capital spending guidance at its next reported quarter. 2. The memory bid does not break before 2027, falsified if conventional memory contract prices post a quarter-over-quarter decline in any quarter through the first quarter of that year. 3. The oil market is underpricing the tail. Falsified if Brent closes below $85 for 5 consecutive sessions before the 16th of September, while Hormuz transit remains impaired. And one piece of housekeeping, stated plainly rather than buried. The calls published in issues 58 through 61 were written into those issues, but never appended to our assumptions ledger. That gap is closed today. And the cleanest way to hold this week is to stop asking whether artificial intelligence is a bubble and start asking what it is outbidding. In July, the answer arrived twice. It outbid a 4 times levered fund's ability to stay solvent, and it outbid Apple for memory. One of those was a financing failure. The other was a demand signal so strong it showed up as a warning in the guidance of the most powerful buyer in consumer electronics. The market treated both as bad news for the same trade. Meanwhile, a government intervened in a currency market for the first time in 15 years, and the 30-year bond closed at a level it last saw in 2007. So here is the question worth sitting with. If the cost of long-dated money is repricing everywhere at once, which balance sheet in your portfolio was built assuming it would not? Today's deep dive takes the Apple story apart in full, and it is linked below. I'm Earl, the asymmetric signal, 1 contrarian read a day. Subscribe. Research and education only, never investment advice.